good morning, everyone. It's really lovely to see you on this Saturday morning, and thank you for joining in. One of the reasons we wanted to do this webinar was because a question that's been on a lot of investors' minds is whether we should be looking at global markets as a wealth creation opportunity, or is there more value to be found in Indian markets? So, this is something that we're going to try to address using data through the course of the webinar. Feel free to ask any of the questions that come to your mind in the chat. We will have a dedicated session for Q&A towards the end of today's session. And before we begin, very happy Diwali to everybody who's here. And without further ado, let's start on what's going on here, right? So I'm going to quickly launch a poll, and there are no right or wrong answers, but it's just sort of like a starting point to get a sense of where each of you think the opportunity is. So I'd request you to quickly sort of rank your preference in terms of where you see opportunities as an investor. So I'm just going to give you a minute or so to do that, and then we'll start with the rest of the webinar. Okay, so I see one question that's come in for China and the USA. All right, so that was just something that we wanted to try in terms of food for thought to see where your preferences are and what's on your mind and the kind of data that you're studying as investors. So let's begin. So first, I'm going to walk you through what's going on in India, and then we will look at roughly, what we're seeing globally. So the India growth story is quite strong. So if we look at, let's say, what our growth projections have been over the last 5 to 6 years, of course, COVID being your FY20 year, you've had a hit on growth. So there we grew less than 5%, but growth has been reasonably solid between FY22 and FY24. And FY25 took a hit, and this year also is expected to be a lower growth year. So our target is sort of to grow between 7.5%. And I think the last 2 years especially have not been able to live up to that expectation. So there was some concern that the Indian economy is slowing down. And I think 2025 has been a relatively challenging year in terms of getting policy in order, because you've had a lot of uncertainty that's been created through the trade sort of tariffs that are coming in from the US government. It's not just on India. I think there's been a lot of ceasefire with global trade partners from the US's side. Apart from that, like, we've seen the domestic economy also slow down to a certain extent, and certain reforms have come in place to address this growth slowdown. And a lot of the policy measures that are coming in are predominantly sort of domestic focused, because that's the part of the economy that policymakers seem to have more ability to control. Right. So we've been on a fairly solid growth trajectory, and the numbers that I'm showing on for 2026, that is 2025, 2026, only Q1 is actual data. The rest of it is expectations. And when we think about expectations, we also see that there's been a significant positive revision upwards on Q1 GDP data. And a lot of the narrative around that number was that there's been a front loading in terms of government expenditure. There's been a front loading in terms of exports because of all of the uncertainty around, the July deadline in terms of the US's tariff game. But when we really look a little bit deeper and we see what contributed to Q1 growth, it's not all front-loading effect. If you compare government expenditure in Q1 of this year with Q1 of last year, you do see that there's been an uptick in how much the government has spent. But that can basically be attributed to the fact that last year was an election year, right? Which means that government spending is constrained until the new government forms. And even once that happens, you see a kind of slowdown because until portfolios are allocated and budgets are sort of created, you don't really see approvals coming in. So, I think comparing Q1 and Q2 data does not really give you a clear picture of how that works. And yes, there has been some increase in terms of exports that have happened. But broadly, if you look at, say, your PMI, which is like your manufacturing and services index, then you see that there's a lot of things that are contributing to it, and it's not one or two factors that have pushed growth up. So the Q1 data is actually quite I think overall a positive sentiment, and it's not driven by a limited set of factors or an unsustainable set of factors. So coming into like the India story, I think why is there a decadal opportunity in India? I think broadly, what the logic is that unlike other big global economies like, let's say, Japan, China, or even the US, our working age population is pretty high, and that's expected to sustain for a long period of time. So there is a demographic advantage that India has over other global economies. And this is largely because we're a growing population and we're also a young population. Now, a lot of other economies are seeing more aging populations come in, which means that the kind of productive labor force or workforce that you have will decrease over a period of time. And at the same time, you're not seeing population growth, which could sustain economic activity for a much longer period of time. So this is one critical advantage. But at the same time, you need to also be able to create jobs, and you need to also be able to create certain outcomes with that kind of population. Otherwise, just having people is not going to give you that edge. Right? But there are some structural strengths that we see in the Indian economy. So if we look at, let's say, how infrastructure has played out, this is a multi-decadal opportunity because you do see a need for higher physical as well as digital infrastructure. And I think we've been quite ahead of the curve in terms of digital infrastructure, because if we look at the kind of payment systems that we have or the financialization of savings that has happened with your JAM Trinity, which is broadly your Jandan, your Aadhaar, and your mobile, this has created a ecosystem where people can move into a more formal structure for their financial savings and so on, right? So, and with UPI, you're seeing more and more optionalities come in, meaning there's also an option to now invest in mutual funds through UPI. You have credit on UPI, which is picking up. So there are many things that are coming in from that base layer, which we have built over the last decade or so. When we look at reforms, I think this year's reforms have largely been on the tax side, especially oriented towards getting more money in the hands of taxpayers. So the changes in the budget earlier this year ensured that people who are earning less than 12 lakhs don't really fall into the tax net at all. This essentially allows you to save as well as spend more money. They also lowered the tax slabs for people who are earning more than 12 lakhs. So this again gives you some benefit. It may not be immediate, it will start kicking in from the next year or so. And lastly, I think we've had the GST reforms also come in, which is more consumer oriented in the sense that you've reduced the GST slabs on many items. They've moved into lower slabs. At the same time, you're allowing more consumption to occur because people will end up having some savings through this process. Now, when GST was initially implemented, there were a lot of hiccups and there was a lot of burden in terms of compliance. And I think over a period of time, there has been some improvement in getting these parameters much better. And I think with any reform, you're going to have that initial phase of hiccups, right? So if you're looking at how you could look at sort of implementing these things, then you do have a bigger advantage when you're able to implement it over a long period of time. So with respect to GST, you need to see what has happened, not just in the year that it got implemented, but when we hit that 1 lakh crore a month target. And then from there, how we've gone into this rationalization and how we're moving into a easier system in terms of compliance. So beyond this, I think there's also been a few pushes in terms of bringing India on par and being able to export to the world. So you do have your production linked incentives, you do have your Make in India push. So these are things that are kind of ensuring that the Indian manufacturing engine starts really working hard. Because so far, the driver of Indian economic growth has been on the services side. And unless you also have this value unlocking that happens in manufacturing, you're not really going to be able to fully get to that 7.5% growth engine that you're talking about. So, what is the growth forecast? I think what we are seeing is that there have broadly been upgrades, especially for this year, whether you're looking at the IMF, you're looking at the RBI or the World Bank, pretty much everyone has sort of upgraded India's growth expectations, despite the level of global uncertainty that is there. So there are a lot of drivers which are independent of what's happening on the global stage, which is supporting economic growth in India. So coming back to inflation. Now, this is a very important parameter because this essentially determines how stable your growth is. And it also kind of addresses the question of, is growth in and of itself occurring, or is it basically inflation driven? Now, in 2016, the RBI set up the Monetary Policy Committee with the intention of having a flexible inflation targeting framework. So the target for Indian inflation, or the sweet spot that the RBI identified, was that our inflation stays around 4%, right? And if inflation is at roughly 4%, you can have variations on the upside as well as the downside, varying by 2%. So ideally, that band where inflation should be somewhere between 2 to 6%, and at the midpoint roughly is where you want your long-term inflation to settle down. And if we just look at how this data has panned out, let's say from 2021 till 2025, because you've had a period of higher inflation due to, say, pandemic-related logistical constraints. You've had a period of low inflation in 2025 due to the changes in vegetable prices, which were very high last year. So you're seeing a cooling and almost like a negative inflation in certain baskets as well. So when we look at this data, we're roughly at 5.1% or so. And this essentially means that we've done a fairly decent job in sticking to the target. And this year's inflation is expected to be much lower, in fact. And the RBI has vocally said that, if inflation continues to be low, then that kind of opens up a lot more policy room for them to ease and support growth. So the conditions to support growth are quite strong where we are today. So globally, if we look at where the IMF is projecting growth, the US economy is expected to grow roughly at 2% between 2025 and 2026. China is heading closer to the 5% range. If we look at, say, Russia and Germany, or like in general, I think the Eurozone itself is growing at roughly 1% or so. And global growth is expected to be closer to 3%. So the economies that are really growing seem to be more on the emerging market side rather than your developed market side. And the US economy also, if we look at how the Federal Reserve has been looking at growth, I think there have been significant changes to the growth expectation between, say, last year and this year, which have been more downward in nature. So the revisions have been that we expect growth to be slower in the US economy in the coming year as well as the current year. Okay. So I think I wanted to launch another poll in terms of where we think depreciation has been. So, anyone wants to take a guess on how currency depreciation has played out? All right, so I do see some answers that have come in, and I think on the slide also we do have the response. So, like if we take 20-year data, the average sort of depreciation that you've seen per year is about 3.6%, right? Now, if you're looking, if you're a global investor and you're sort of looking to allocate to India, then of course currency depreciation needs to factor into your entire calculation. But if you're a domestic investor, then I don't think currency depreciation really matters too much, because you also need to look at what are the potential returns that you could earn in each market based on like growth plus alpha from there, as well as what you're getting in terms of your valuation comfort. Right? So upwards of, say, like mathematically, if we look at it, if you lose 3.5 4% to currency depreciation, then you would want a decent alpha over that, right? So if you're able to grow at, say, 13 to 15% post fees, then I think that's a good number for you to target in terms of where you should set your return expectation. So now moving on to more dollar trends, right? So I'm going to show you two charts here, and let's spend some time in understanding what's going on with the dollar as well. So if we look at the 20-year trend of the DXY, which is the dollar index, this essentially gives us a sense of how has the dollar performed over a 20-year period. And you see that there has been like a 1% kind of compounded growth that has happened. So the dollar over the last 20 years has appreciated relative to itself. That's the way we can think of the chart on the left. When we look at the chart on the right, 2025 as a year really stands out, because the long-term trend of the dollar has been that it's been appreciating consistently, and the short-term, if we look at the chart on the left, let me just repeat this for everyone's benefit because the charts were not visible. This shows us the long-term trend of the dollar, and you can actually see this last leg, right, which is 2025, which is what I've sort of expanded for you on the right side. So you've had a long-term appreciating trend, and then over the last 3 or so years, like you can see that you peaked out around 2022, 2023, and then you had a depreciating trend in the dollar. So so you are at some kind of inflection point where the dollar valuation is not really sticking to what has been the trend over a long period of time. But that being said, you have had phases where the dollar has depreciated relative to itself and then gone on to appreciate. But 2025 really sticks out because the year-to-date depreciation on the dollar with respect to itself has been about 10%. And I think there are certain drivers, and we'll get into what is really pushing or what really determines where the dollar value will stand. Right. So if we look at the drivers, one and possibly the most important level is where the federal funds rate is and what your monetary policy stance is. Right. So when you see monetary policy easing, that is, you're looking at lower interest rates, the returns that you can earn from dollar-based assets like bonds would actually reduce. And that is where you're seeing the market sort of price in what's going on, because the Fed has been sort of vocal in terms of saying that we expect interest rates to be lower, and the rate cuts have been pushed. So you're seeing some pressure on the dollar come in from rate cuts, right? What sort of pushes the dollar up has been global risk events. So every time you've had some kind of global crisis, there is a flight to safety, and dollar is one of the demand assets. But in this cycle, the demand asset has really not been the dollar, and instead you've seen money move into store of value assets like your precious metals basket, right? Oil prices have actually been very benign, and despite that, you are sort of experiencing some level of dollar weakness that is occurring this year, right? And again, I think this is largely because you can look at oil, gold, and dollar together. And when you see that, you're actually seeing that oil is significantly undervalued. You're seeing that gold has gone up quite a bit, and the dollar has also weakened a fair amount. So the question in terms of relative valuations would sort of show you that maybe gold relative to dollar needs to see some kind of reversion. And then, of course, you have more macro related data points like your fiscal policy. And here, I think a lot of attention has come into the US economy, primarily because you have had a phase where there has been excessive government spending for decades, and that kind of deficit is putting pressure on the US Treasury in terms of how much the Treasury is going to be paying out, as well as the expansion of the Fed's balance sheet, which also has certain second order impacts on dollar valuation. Lastly, you want to look at inflation, because one of the things that can again sort of negatively impact the dollar valuation is how much inflation the economy is experiencing. So if the value of a dollar goes down because the price of goods and services go up, then automatically you are going to see some level of depreciation there, right? And of course, again, I think the focus this year has been all about trade and tariffs, and the tariff changes are really not improving the trade balance in a meaningful way. It's just optically creating some kind of positive impact, but from a financial perspective, the impact of higher tariffs is minimal in terms of increasing US government revenues or settling trade deficits. And at the same time, what you are also seeing is that it's creating a lot of inflation in the domestic US economy, right? And of course, we are in a phase where growth is not ideal for the US because you're growing sub 2%. And when you see broader based economic growth, you are going to actually have a performance in terms of positive DXY or appreciation in the dollar. So we just put together some data points in terms of what is the cyclically adjusted PE ratio, right? And here, this chart kind of shows you that India's cyclically adjusted PE ratio is much higher. But structurally, I think what we want to look at is that you've moved into a higher growth era, and it's not really sensible to look at, say, 1991 to 2010 2015 data, because there have been structural changes in that phase, right? At the same time, there is a question of how expensive are Indian markets on the whole. And if we look at the US as well, there you are seeing relatively higher valuations, and you're also looking at a lower growth era compared to what you've had in the last decade or so. I think this shows us that, relatively, both US as well as India are looking a little bit expensive. But when we look at, say, an economy like China, it's very clearly at a cyclically at a attractive valuation, right? So this is basically to sort of look at how we launched that initial poll in terms of understanding where you see opportunities and how you want to view them going forward. So the question is, are Indian markets really that expensive? So if we look at the trailing price to earnings ratio, I think the US is trading at a higher valuation than India. And India is trading at a higher valuation than most of the other peers. That being said, I do think that we also need to look at price to earnings, not just in terms of what is the multiple, but also in terms of forward looking growth expectations. And for the next few years, at least, I think India growth seems to be fairly strong. And whatever headwinds we are facing, there are certain domestic policies that could actually support us even through a little bit of adversity. At the same time, I think what won't work in both the markets is an index-based approach to investing, because a more bottom-up story protects you from some of the valuation risks that are very visible in your index level valuations. It also protects you from sectors that could be impacted by global events, or uh, and exposes you to sectors that are going to benefit from some of the reforms that you're seeing, right? So, how are foreign investors looking at India? And I think broadly, the last few years, there have been pretty severe outflows, including this year to date. There have been a lot of profit booking or exits that have happened on the FII side. And if we look at the difference between, say, 10 years ago to today, the key difference is that domestic participation has been so robust that you've not really seen indices fall as much as they should, or as much as they have in the past. Due to FII selling. So there is some more strength and stability in domestic markets, which is lending more comfort for, say, FIIs to participate. And in October, we have seen a mild reversal in this trend, where we're actually seeing FIIs come back and initiate some level of buying that's going on here. And from an entry standpoint, I think the last 1 year has been relatively flat if you look at index level performance for India. But you've also got a re-entry point, in the sense that now you can look at valuations, and while the next year's growth numbers are not looking so eye-watering, from 2028 onwards, the expectations are pretty decent. So somebody with a longer-term mindset and investment horizon could actually benefit from an India allocation today. So, lastly, I think one topic that has been of hot debate has been how the AI theme is actually revolutionizing a lot of things, and how that is a theme that has a lot of growth potential, which is why you're also seeing this performance come in terms of US index level returns, right? So if we look at year-to-date returns on the S&P 500 or the Nasdaq 100, you're seeing anywhere between 13 to 18% as your yearly return, right? Or just your 2025 kind of return. So this, I think, becomes a question of balancing these two ideas. Yes, a theme has growth, but how much more value does it inherently contain is a question that we need to be asking. And when we start asking that question, I think there are some important data points that show us that a bulk of the returns have actually come from a very narrow set of stocks. And this has kind of changed the way the index itself is composed, because basically how index investing works is that whatever performs starts getting a higher allocation in the index. And this is a fantastic way to sort of participate while you're in a growth trajectory or an upward growth trajectory. But when you see growth slowing down, you actually need to have a higher allocation to defensives and cyclicals. And at the index level, that is something that is missing when you look at US markets, because the index itself is oriented towards the tech heavy companies, which have contributed to 75% of the return. So if you decompose the returns and see where they've come from, a bulk of it, or 3/4 of it, have actually just come from your AI related stocks. And if we look at earnings growth, so far that earnings growth 80% has come only from AI driven stocks, right? And but at the end of the day, we also want to look at like who is spending and who has the capacity to grow. And 90% of capital capex is coming through AI. So this is a situation where being over allocated does not make sense. But at the same time, some level of allocation, especially if your allocation has happened at a lower cost point, could make sense, right? So I think just a few points that came out from the MIT report on AI use was that, it's not as rosy as it looks, because most pilots fail, and integration is challenging. You also have multiple tools at an individual's disposal, right? So there is no loyalty or there's no individual or a specific kind of AI tool that benefits. This is more of like a broad-based use of a suite of tools. And there's also this whole sort of debate on whether you want to buy or you want to build, right? So do you want to have an external vendor who's giving you a pre-designed model versus do you want to design something in-house? And this is an important question because it ties back to the first point, which is that a lot of the pilots that you try out are actually not going to succeed. And the financial impact also is not as high as you think it is. But this is ultimately the cutting edge of technology. It could potentially change the entire landscape of the labor market as far as technology is concerned. And it is one of the themes where a lot of investments are happening and fine tuning is happening. So the potential is definitely there. Right. So I think the India story is largely built on the idea that, okay, you have a fast growing economy, you have a young economy, and there are a lot of reforms that are going on here. And I think that picture is very optimistic and only looks at the plus side. But I think if we were to take a more measured and contrarian sort of approach, I think what we would want to look at and what gives us confidence on the India side is that you do have a growth premium, meaning if we compare to developed markets, India is growing at a faster pace, and that growth is likely to sustain for a longer period of time. You're also seeing this in terms of how consumption is playing out because the younger generation is far more aspirational, has a higher level of disposable income. So there is growth that can come from consumption as a driver itself. You have lower level of fiscal burden. So if we look at how the government has been managing its fiscal deficit, there has definitely been a more disciplined approach to how things work out. And because you're managing debt well, that means your debt is more meaningful. You have more visibility to sort of reinvest, and any shocks that come in can be handled through the fiscal side as well. You're also seeing tax collections go up while tax rates are coming down, which I think is a fairly commendable thing to do because the tax net is getting wider, right? And lastly, from a global edge, I think there is potential. I had shared some data on FII flows earlier. There is potential for India to receive a higher allocation from global flows. And this is primarily because one, you've had a period of underperformance. So when it comes to rebalancing, you're again coming back to businesses or indices at the same price level that you were, say, a year ago versus having better prospects going forward. So that is definitely one thing. The second thing that you want to do is look at how FIIs have been consistent sellers for a long period of time. And from a macro as well as a rating standpoint, India is getting more positive flows, or rather more positive news, which could be a trigger for flows as well. So lastly, I'd like to talk about the product Sphere, which is our multi-asset PMS. So for those of you who have been investing, I think you're quite familiar with our work. But for those of you who are new to this, Sphere is our product where we want to basically simplify a lot of decision making for the investor. We don't want people to have a stressful investment experience. So the idea is that you never really have to worry about, is this the right time to participate? When should you really be scaling up your investments? Where do you invest? How much do you invest? And all of this, right? Because I think this occupies a significant part of our mind share when we are looking at wealth creation. So with multi-asset investing, we're basically able to solve a lot of this because we figure out what is the right place to invest, how much to invest, and scaling up becomes very easy because that is more goal aligned and based on what the investor wants to achieve in terms of a milestone. And it also completely resolves this question of, okay, should I wait now or should I wait wait for markets to correct, because there's always an asset class that's worth participating in. Through this product, we're also able to challenge the risk reward equation, which is, you believe that you have to take a higher level of risk to get better returns, or if you moderate your risk taking, you're going to end up with very mediocre returns. So we're able to do this because we have a very strong framework in terms of being contrarian. So we limit the kind of downside that an investor experiences, and at the same time leaves more room for upside performance. Contrarian essentially means that we're very early to certain themes, and that gives us more stable performance. And of course, the multi-asset route does give us the advantage of flexibility, meaning there's always some particular asset that we could look at owning, and stabilizes performance over long periods of time. Now, while it's great to talk about all of that, I think from an investor's perspective, it's important to also measure drawdowns. And when we look at drawdowns, I think in the last year or so, which is, let's say last year, you had a high of your Nifty hit an all-time high. And then we had a drawdown period, say from last September till about March, April this year. And in this phase, the Sphere's drawdown was about 10 to 10.5%. At the same time, the Nifty drawdown was anywhere between 12 to 16%. And the multi-asset index obviously fell less because it's much more conservative. It has a higher allocation to arbitrage. Almost 40% of the benchmark index is in arbitrage opportunities. So there you see a drawdown of say 6 to 8.5% or so. And again, another pure equity index like the Nifty 500 fell anywhere between 13 to say 20% or so. So this definitely protects you on the downside. What we're doing in terms of value contrarian and multi-asset investing is able to give you that. And at the same time, I think upside potential also is there. So we've been able to consistently beat the multi-asset index as well as the Nifty on the longer term horizons. And if you look at 2, 3 and since inception returns, those are definitely on the higher side. A product like Sphere is not designed to deliver those kind of returns. I think if we look at the allocation also, we've had a fairly reasonable allocation to the precious metal basket, which has contributed to these recent returns. And I think in terms of setting the right expectation, a multi-asset index is, a multi-asset investment is going to be more conservatively managed, and a more reasonable return expectation should be, say, around 10 to 12% compounded, right? So if we're looking at how to set those return expectations, I think you want to beat inflation by about 5%. And that's how we should look at benchmarking what to set in terms of how you achieve those things. So some of our key portfolio terms, we are a SEBI registered PMS, which means our minimum ticket size is going to be 50 lakhs. The benchmark index is the NSE Multi-Asset Index 1. There is no exit load on this product. And we have only a fixed fee. There's no performance fee as well. And ideally, we would recommend that an investor comes in with a 5 to 7 year horizon, even though there's no exit load. And this is because you want to experience a cycle in multi-asset investing. You also have longer cycles in assets and themes. So it makes sense to stick around and create wealth for the long run. We have a lot of flexibility in terms of the asset allocation, meaning we can go 0 to 100% in pretty much anything that's there.